Silver is trading at $65.80. 3 months ago, that was resistance, a ceiling the market couldn't break through. Today, it's the floor. And the most important part? The banks that spent decades suppressing silver's price are now the ones forced to buy it. Not because they want to, because they have no choice. For 40 years, major financial institutions controlled the silver market through short positions. Massive paper contracts betting the price would fall, or more accurately, ensuring it would. JP Morgan, HSBC, Scotiabank, Deutsche Bank. These weren't trades, these were control mechanisms. They sold silver they didn't have, suppressed rallies with coordinated selling, profited from price manipulation, while paying occasional fines as a cost of doing business. That era just ended. Not because regulators finally acted, not because the banks developed ethics, because the physical market forced their hand. 65.80 isn't just a price. It's the level where short positions become untenable, where paper promises meet physical reality, where decades of manipulation collapse under their own weight. The banks are now forced buyers, and every dollar silver rises from here makes their situation more desperate. Let's establish exactly what changed. The COMEX silver futures market is where price discovery happens, where traders buy and sell contracts representing 5,000 ounces of silver each. For years, the ratio of paper contracts to physical silver available for delivery was manageable, maybe 20 to 1, 30 to 1. That ratio provided leverage but maintained the illusion that contracts could be honored if needed. Today, that ratio exceeds 150 to 1. COMEX registered silver, the metal actually available for immediate delivery, sits at 73 million ounces. Open interest, the number of outstanding futures contracts, represents 11 billion ounces. 150 paper claims on every physical ounce. This worked as long as nobody demanded delivery, as long as traders rolled contracts forward or settled in cash, as long as the system operated on trust rather than verification. December 2024 changed that calculation. First notice day for December, contracts saw delivery demands of 9.4 million ounces. That's 13% of total registered inventory demanded in 1 month. January contracts show even higher delivery intent. Preliminary data suggests 12 million ounces. If this trend continues, COMEX registered inventory will be depleted in 6 months. Not reduced. Depleted. Gone. And here's the mechanism that makes this a forced buying situation. When a short seller holds a futures contract and delivery is demanded, they have two options: deliver the physical metal or buy back the contract at current market price. If they can't source physical metal, they must buy back the contract, at whatever price that requires. When you're short 100 million ounces and physical isn't available, you become a forced buyer of 100 million ounces of paper contracts. That buying pressure drives prices higher, which triggers more delivery demands, which depletes more inventory, which forces more short covering. It's a feedback loop, and it's accelerating. The breaking point is 65.80. Below that price, shorts could manage their positions, roll contracts, wait for sell-offs, maintain control. Above 65.80, the math breaks. Physical premiums widen. Delivery demands increase. Inventory depletion accelerates. The banks, holding massive short positions, just crossed into forced buyer territory. And they can't get out without pushing prices dramatically higher. JP Morgan's silver position is the largest and most documented. Between 2008 and 2016, they accumulated short positions exceeding 300 million ounces. 300 million ounces of contracts promising to deliver silver at suppressed prices. During that same period, oddly, JP Morgan also accumulated physical silver. Lots of it. Warehouse receipts and shipping manifests, tracked by independent researchers, suggest they amassed over 800 million ounces of physical metal. The strategy was elegant. Short the paper market to suppress prices. Buy physical at those suppressed prices. Profit on both sides. In 2020, traders at JP Morgan pled guilty to spoofing and market manipulation. The bank paid nearly $1 billion in fines. The manipulation was proven, admitted, documented in court filings, but the positions remained. The shorts didn't disappear, they just got better at hiding them. Now, those positions are underwater, because while JP Morgan accumulated physical, so did everyone else who figured out the game. China imported 600 million ounces more than their industrial consumption over 3 years. India's silver imports hit record levels in 2023 and 2024. Middle Eastern sovereign wealth funds quietly accumulated through London dealers. The physical metal left the market, moved into strong hands, into vaults that aren't selling. JP Morgan's 800 million ounces sounds massive until you realize global investment demand is 2 billion ounces and rising, and industrial demand consumes 560 million ounces annually with no available substitute for most applications. The bank's physical position isn't enough to cover their paper obligations if delivery demands continue. And delivery demands are continuing because sophisticated traders now understand the vulnerability. Hedge funds analyzed the COMEX inventory data. They calculated the depletion rate. They identified the breaking point, and they're systematically demanding delivery. Not to acquire silver for industrial use, to force the shorts into an impossible position. Stand for delivery, take physical metal off the market, force the remaining shorts to cover at higher prices. It's a coordinated assault on a manipulated market, and it's working. HSBC faced similar pressure in London. In March 2024, they announced they were exiting precious metals trading entirely, not reducing positions. Exiting. That's not a business decision. That's a surrender. Scotiabank followed in June, out of precious metals, closing positions, taking losses. Deutsche Bank is rumored to be negotiating an exit, but their exposure is so large they can't unwind without moving the market against themselves. These aren't small players. These are the institutions that controlled silver pricing for decades, and they're capitulating, one by one, because the alternative is worse. When you're short silver at $40 and the price is $65.80, you're already down 64% on those positions. If silver moves to $80, losses double. At $100, the positions become catastrophic, and there's no way to exit a 300 million ounce short position without buying 300 million ounces, which means driving the price up, which means larger losses, which means more forced buying. The trap is perfect. The banks that spent 40 years manipulating silver down are now trapped in positions that force them to push silver up. Every attempt to exit makes the exit more expensive. Every dollar silver rises makes the remaining short position more toxic. They're forced buyers, and they know it. Internal risk reports that leaked from one major bank in September showed silver exposure classified as critical systemic risk. Not moderate risk, not elevated risk, systemic. Meaning the bank's executive team believes uncontrolled silver price movements could threaten the institution's solvency. That's how large these positions are. That's how badly they're trapped. And the traders forcing delivery know it. This isn't speculation. This is game theory playing out in commodity markets. The shorts are cornered. The physical is disappearing. The price is rising. And every bank with silver exposure is now a forced buyer trying to minimize losses rather than maximize profits. The control they spent decades establishing is gone. Here's what the numbers demand happens next. Current COMEX registered inventory, 73 million ounces. Current delivery demand rate, 10 million ounces per month. Depletion timeline, 7 months. That's not a prediction, that's arithmetic. Unless delivery demands decrease or registered inventory increases, COMEX runs out of silver by July 2025, and neither condition is likely. Delivery demands are increasing, not decreasing. Traders smell blood. Every successful delivery emboldens more delivery attempts. Registered inventory is not increasing because there's no incentive to add metal to COMEX warehouses when physical premiums are rising. Why would a silver holder put their metal into COMEX registered inventory where it can be claimed at spot price when they can sell it in the physical market for $3 to $5 over spot? The rational choice is to hold physical or sell at premium, not to register with COMEX, which means inventory continues depleting, which means delivery pressure continues building, which means the timeline to crisis continues compressing. At some point before complete depletion, COMEX will act. They'll change the rules, implement delivery limits, force cash settlement, suspend trading. London Metal Exchange did exactly this during the nickel crisis in March 2022. Positions got too large, shorts got trapped, exchange intervened, canceled trades, changed margins, protected the shorts at the expense of longs. COMEX will likely follow the same playbook. But here's why that doesn't save the banks. When COMEX changes the rules to protect shorts, it destroys the legitimacy of paper silver contracts. If contracts can be canceled or cash settled against the holder's will, they're not fungible with physical metal. The divergence becomes official. Paper silver trades at whatever price COMEX dictates. Physical silver trades at whatever price clears the real market. And suddenly, the bank's short positions on COMEX are irrelevant because the real price discovery happens in physical markets. Shanghai, India, London allocated, retail dealers. If physical silver trades at $90 while COMEX paper trades at $70, the banks still face catastrophic losses. Because their industrial clients, the manufacturers who need real silver, will pay physical prices. And the bank's hedging strategies, built around COMEX paper prices, become worthless. The forced buying doesn't stop, it just shifts to different markets. Banks with delivery obligations to industrial clients will buy at physical prices because they have no choice. Banks with derivative exposure will watch their hedges fail as basis risk explodes. Banks with lending exposure to silver miners will face collateral reevaluations as paper and physical diverge. 65.80 is the floor because below this level, the paper market still functioned. Above 65.80, the divergence accelerates. By 75, physical premiums hit 10%. By 85, premiums reach 20%. By 100, paper and physical are functionally separate markets. And the banks, regardless of which market they operate in, are forced buyers. Because they're short a commodity that's disappearing from available supply, while demand increases from industrial, investment, and strategic sources simultaneously. The mathematics are unforgiving. The only variables are timeline and magnitude, not whether the banks are forced to buy, but how much they're forced to buy and at what price. The forced buying situation gets worse when you factor in industrial demand. Banks aren't just managing speculative positions. They're servicing industrial clients who need physical silver for manufacturing. Major electronics manufacturers have supply agreements with banks, guaranteed delivery at hedged prices. Solar panel manufacturers have forward contracts, locked-in costs for silver in production. Medical device companies have just-in-time supply chains dependent on reliable silver availability. These aren't paper contracts that can be cash settled. These are real-world delivery obligations. And when a bank can't source physical silver to fulfill an industrial contract, that's a default. Defaulting on industrial supply contracts has consequences beyond financial losses: loss of client relationships, litigation, reputational damage, regulatory scrutiny. Banks will pay almost any price to avoid industrial defaults, which means when physical silver becomes scarce, industrial demand becomes inelastic. A solar manufacturer can't build panels without silver. They'll pay $70, $80, $90 per ounce because shutting down production costs more than expensive silver. An electronics manufacturer can't substitute silver in critical applications. They need the conductivity. They need the reliability. Medical device manufacturers can't use alternatives in antimicrobial applications. Silver is uniquely effective. This industrial demand creates a floor under physical prices that rises regardless of paper market manipulation. And banks with industrial clients are forced to buy at those physical prices or face contractual default. The short positions they hold on COMEX are separate from, but related to their industrial obligations. They thought they could hedge one against the other, short paper to offset physical obligations. That strategy collapses when paper and physical diverge. Suddenly, they're losing money on paper shorts, while simultaneously paying premium prices for physical delivery. Trapped on both sides, the industrial pressure ensures that even if COMEX suspends trading, even if paper markets freeze, the forced buying continues, because factories need silver, and banks promise to provide it. There's another layer that makes the forced buying irreversible. Sovereign nations are accumulating silver as a strategic resource, not for investment, for industrial and technological sovereignty. China's accumulation is documented through import data, 600 million ounces beyond industrial consumption in 3 years. That silver went into state reserves. It's not coming back to market. India imports silver at rates that exceed their traditional jewelry and industrial use. Central Bank of India data shows undisclosed precious metal accumulation. Russia has been converting dollar reserves into hard assets, gold primarily, but also silver. Middle Eastern nations, flush with energy revenue, are diversifying into commodities. These aren't traders looking for profit. These are nations securing resources for future industrial needs. They understand that green energy mandates, military electronics, and advanced manufacturing all require silver. And they're ensuring their domestic industries have access while potential adversaries don't. This sovereign accumulation removes silver from commercial markets permanently, which tightens supply, which increases scarcity, which forces price higher, and which ensures that banks trying to buy physical silver to cover obligations are competing against nations with effectively unlimited budgets. You can't outbid a sovereign nation securing strategic resources. The banks are forced buyers in a market where the ultimate buyers aren't price sensitive. This is the nightmare scenario for any short position, competing against buyers who will pay any price to secure supply. 65.80 is the new floor, not because analysts drew a line on a chart, not because of technical support, because the mathematical and physical reality of the silver market changed. The banks that controlled price through massive short positions are now trapped. They can't exit without buying. They can't buy without driving prices higher. They can't stop buying because inventory is depleting and delivery demands are increasing. They're forced buyers. And every dollar silver rises from 65.80 makes their position more desperate. This isn't temporary. This isn't a squeeze that resolves and returns to normal. This is a regime change in the silver market. For 40 years, price was determined by paper contracts and bank manipulation. Now, price is being determined by physical availability and delivery demands. The banks see it. Risk reports classify silver as systemic risk. Institutions are exiting precious metals entirely rather than manage the exposure. The traders see it. Delivery demands are accelerating. Physical premiums are widening. The paper market is breaking. Industrial users see it. They're signing long-term contracts at elevated prices because securing supply is more important than cost. The sovereign nations see it. They're accumulating at rates that remove millions of ounces from commercial availability. Everyone involved in the silver market knows the floor is 65.80 and rising. Except the paper market hasn't fully adjusted yet. Futures contracts still trade. Like this is 2020. Like banks control price. Like physical doesn't matter, but physical is all that matters now. When COMEX registered inventory depletes, when exchanges change rules to protect shorts, when paper and physical markets officially diverge, the price discovery moves entirely to physical markets, and physical markets are already trading above paper. The forced buying will accelerate, not because of speculation, because of necessity. Banks must cover shorts, industrials must secure supply, nations must build reserves. All buyers, no sellers at current prices. This is global economy tales. And we're watching a market structure collapse in real time. The banks that manipulated silver for decades are now the victims of their own manipulation. They created massive short positions in a commodity with inelastic industrial demand, limited supply, and increasing strategic importance. And now they're trapped. Every attempt to exit drives price higher. Every price increase makes the remaining position more toxic. Every day that passes, more physical disappears from available inventory. 65.80 isn't a price target, it's a threshold. Below it, the old market structure barely functioned. Above it, the new reality takes over. The banks are forced buyers now, and they'll keep buying. At 70, at 80, at 100, until their positions are closed, or until they default. Either outcome pushes silver dramatically higher. The floor is 65.80. The ceiling is wherever forced buying stops. And forced buying doesn't stop until the shorts are covered or the banks are broken. The only question is which comes first.